Well, good morning, everybody, and a very warm welcome to our online webinar this morning that will be considering some of the challenges that recent market conditions are having on financing real estate projects. My name is Kevin Marriott from IPSX, and it is my pleasure to be your host today. Almost every business across every sector in the United Kingdom has been adversely affected by coronavirus. And in today's session, we're going to be discussing options that owners of real estate now have when thinking about capital raising and the options they have for considering for new finance. There's also going to be some audience interaction with some live polling, and I'll come back to how that's going to work a little bit later on. But first of all, let me start by thanking our virtual hosts today, Addleshaw Goddard, and thank you to their team for helping us put together today's webinar. I'm sure we're going to be in for a really, really great session. So let's make a start by welcoming our guests that are going to guide us through today's topic. Firstly, it's my great pleasure to introduce Peter Kershaw, who's the partner from Addleshaw Goddard. Good morning, Peter.
Good morning, Kevin. Thank you.
And let's move on and introduce Charles Smith, International Partner, Chairman for the Valuation and Advisory at Cushman and Wakefield. Good morning, Charles.
Good morning.
Good morning. And to Adam Posner, who's an Associate Director at KPMG. Good morning, Adam.
Hi, good morning, Kevin and everyone.
And lastly, to Roger Clarke, Managing Director and Head of Capital Markets at IPSX.
Good morning, everyone.
So before we make a start, just some housekeeping points, if I may, to all our attendees, and I can see that we've got quite a number of you this morning that have joined us. Please may I ask all of you that if you want to share any questions or thoughts or observations to the panel, please use your Q&A box that you will find at the bottom of your Zoom bar. We have muted all participants today just because it's much easier to be able to manage these kind of sessions. But all the panelists will be able to see your questions as they arrive. So please do share those. And if there's a particular panelist that you would like to put a question to, then just by all means put your name to them as well. Now, I mentioned right at the beginning that we were going to have some audience interaction. And we're going to make a start with our first one, which is the form of a vote. And all we'd ask you to do is just vote yes or no to the question that we are now going to put to you. So may we have the question, please? And I think hopefully that's just arrived on the screen. Yes, it has. Very good. So the question is, do you think we will see businesses moving away from the more traditional approaches of debt financing to considering new options when using their real estate? So if you think that's going to happen, tick yes. And if you think it's not going to happen, please tick no. So if you could vote away, please. And we'll just pause whilst we gather your thoughts on that vote. And I'm sure the panel will be reflecting on your responses. So let's take the question away, please. And if we could have the results to that. Wow, look at that. We have a very heavy swing, 76% saying yes to that, with just a smaller minority of 24% saying no. Great. Okay, let's take that question away. Thank you very much. All right, so let's start the session. And to help us set the scene, I'm going to invite Roger Clarke from IPSX to give us a bit of an update on the progress that IPSX has been making and the news of the second market of wholesale that was announced at the beginning of the year. And I think what is going to be particularly interesting is to hear from Roger about the progress this is going to be, this is made, and how this can help with fundraising. Roger, it's been 6 months or so since we were last in Manchester in the Northwest, hosting our last event with Addleshaw Goddard, and I think it's fair to say there's been quite a lot happening. Could you give us a bit of an update?
Yeah, thank you, Kevin. And again, good morning, everybody. Yes, a lot has happened in those 6 months. We've left the EU, if anybody remembers that, and of course we've all learned how to use Zoom. But Kevin, if we can move on to the first slide, I think that what I'd like to do is just give everybody a recap on what IPSX was 6 months ago, and then explain what developments we've had. So IPSX IPSX, and by the way, I'm very pleased to see the response to your first question, Kevin, because if people are looking to move away from traditional debt markets, we think IPSX is definitely part of the solution there. What is IPSX? It is a stock market dedicated to commercial real estate. It's a stock market just like everybody is used to. It's regulated by the FCA. It is technically called a recognised investment exchange. That's equivalent in every way to the London Stock Exchange or to Euronext. It also is, for the purposes of HMRC, for the Treasury, it's recognised as a recognised stock exchange. And that's important because it means companies which list on IPSX are capable of being REITs. And in certain circumstances, of course, that means even if they own a single asset, they can be a REIT. IPSX, like the LSE, is a MiFID II platform, which means many things, but most pertinently, it means that for people who can't normally buy commercial real estate, for everyone from the man in the street up to the small institution that can't run its own real estate team, they can now buy shares in companies, and those shares can go into a SIP or an ISA. So, just as a recap, some of the headlines. The company that lists on the market owns a single piece of real estate. It has to sell at least 25% of the shares in that company to go onto our prime market, which is open to all investors, including retail. The assets need to be low risk. The LTV is limited to 40%, and they need to be income producing, stabilized assets, analogous to core or core plus assets in a private fund. The company, or the issuer as it's known, will produce a prospectus. This is a very full document that's produced with the help of lawyers, accountants, expert valuers. So all of the people we've got on the webinar with us today would be involved in putting together this document, and effectively it is a fully vetted, pre-approved piece of due diligence. And importantly, really importantly, when the IPO has happened, liquidity is provided in the shares by a system of market makers. Again, it's just like the stock market that everyone is used to, the LSE. Market makers will make two-way prices all day long. Liquidity in that way is guaranteed. And of course, for the man in the street, that's quite an important comparison with some of the retail funds which are gated today. You will never get gated in a share on IPSX. So that's what we had. That's what we talked about last time we visited Manchester 6 months ago. Since then, we have had approval for a second market called IPSX Wholesale. And this has some important differences. It's not for retail investors, it's only for institutional investors. This has some important implications though. Firstly, it means if you're an owner of real estate, it means that a prospectus is not required. Something known as an admission document is required, which just gets submitted to us as the exchange. It doesn't need to be pre-approved by the FCA. That has really important implications for time and cost. It's quicker and cheaper than a full-blown prospectus process. Because retail investors aren't allowed to invest in this market, then some of the protections that the FCA require for the man in the street aren't necessary. LTV can be much higher, as much as 80%. The assets don't need to be income producing at the time of IPO. So that could mean we see development financing raised here. It could mean we see public-private partnerships. A lot of conversations we're having with the public sector about how to bring in private sector partnership in a new way here. We could see refurbishments. We could see much higher LTV generating higher returns. For those used to private equity funds, this is much more analogous, capable of being analogous to value add or opportunistic returns. And lastly, perhaps the most important difference is there is no prescribed minimum free float. This means that companies that don't actually necessarily want to sell their assets, but would like to enter the listed markets, are able to do so without having to sell anything like as much as they usually do on a stock exchange. Who might want to do that? Well, we've listed here an example of JV REITs. Anyone who's got an offshore structure at the moment, many of you that are involved in advising companies like this will know that the tax laws, the tax regime has changed in the last 12 to 15 months, such that a lot of UK assets which are held offshore are now going to be taxed anyway, regardless of the holding structure. An obvious way to address this is to become a REIT, but you've got to be listed or admitted to trading on an exchange like ours to be a REIT. So the fact that you can do that without having to sell 25%, 50% of the asset, you could sell as in certain circumstances as little as 1% of the shares in the company. It is a very interesting and attractive new feature of a London-based, London-regulated stock market. That's the really big new development we've had in the last 6 months. So Kevin, if we just could go through to not the next slide, the next one after this. Just as a recap, what is attractive to investors? I mean, at the end of the day, I've been talking about why this market is interesting for owners of real estate, whether they be corporate owner-occupiers or whether they be institutional investors. But of course, it only really works as a stock market if investors are there and interested in buying shares in these companies. And they are. They really are. And why is that? Because if we can attract new real estate to this stock market, this is really interesting for investors. At the moment, they're really limited to investing into funds run by the big institutions. And I've mentioned in passing some of the issues there with gating, etc. Those funds tend to have traditionally been put together as being what's called a balanced fund. So you might get a bit of office, you might get a bit of retail, you might get a bit of industrial. You certainly aren't going to get any choice or control over what's in there. Or people have been able to invest in REITs. But again, if you invest in a large diversified REIT, you're really giving your money to management and asking them to allocate it. It's access to new tangible product where you have some control over the investment decision. Very, very interesting for investors. As of course is transparency around market pricing. As I said, a lot of funds are gated at the moment. Interestingly, they're gated today for different reasons to why they gated in 2016 after the Brexit referendum. Then they gated because there was a mad rush for the door and everybody tried to sell at the same time, which led to a liquidity crunch. This time is slightly different. I think people haven't decided that real estate is something they don't want to be in anymore. But what we have done, and of course Charles will, I assume, talk about this a little bit in a moment, what we have done is had some uncertainty around what things are worth. And at the direction of the FCA and RICS, a lot of these funds have gated because they basically said, we just don't know what our assets are worth. You never get that in a listed environment. You might not like the price, but there's always a price. There's always a price that marks the asset. And there's always a price at which you can trade. And lastly, of course, that price comes with regulation and protection from the FCA. Just very lastly, I'm going to ask Kevin to spin through these next slides quickly, but just to give you an idea of what our trading platform will look like if you wanted to buy shares in an IPSX listed company. You would land on this page. These are pro formas, of course, but you would land on this page and see all of the companies which are listed. If you wanted to pick Cobra Place, for example, which is a fictitious building, you would go through to this page, which is the security specific home page. And then on here, there are, of course, various menus, and you could go through to some of the, if we could go on, Kevin, go through to some of the actual trading metrics there and some of the data. So, but that's how it would look for an investor. Again, you might say just a little bit like, quite similar to going onto the LSE and trying to see what Vodafone's share price is today. Kevin, I'm going to pause there. That's our update. That's our new news. And at this point, I will hand back to you.
Great. Thanks very much indeed, Roger. And I'm sure there's going to be quite a number of questions and thoughts that audience have got around some of the things that you have said, and particularly your points around what the wholesale market can provide, which is clearly, as you've just demonstrated, very different to prime. So I'm sure we'll be coming back to that. But let's go to Charles. Charles, there's obviously been a fairly busy time, I should say, for you. What would you say has been really the biggest challenge that you and others in the valuation profession have been facing up to?
Thank you, Kevin. Good morning to everybody. Well, certainly challenge has been an oft-used word over the last few weeks and now months. I think it's fair to say in 30 years of my career, it is the most difficult period that I've experienced, and we've been through a few that we can all think of. I think one of the biggest challenges that we face as valuers at the moment is the lack of volume of commercial and indeed residential, where that is relevant, transactions in the market, and that lack of near-term pricing discovery does mean that valuers have to look further afield, and that's not necessarily a bad thing. So maybe triple B rated bond market, looking at currency markets, equity markets, just testing the temperature there. And the other, of course, is being very close to colleagues who are active in the market and understanding at least the mood music and the sentiment that exists in the background. There are undoubtedly some markets where there is some liquidity, certainly from a relative sense. So central London offices would be one, where we've seen a number of transactions that have taken place, and not only what one might describe as momentum transactions. There have been other units or properties that have come to the market and are either under offer or moving forward since COVID sort of really hit home and the lockdown was instigated. And that does give us some good insight. So I would probably give an example in London, the Helical sale, where they had a property under offer. It was under offer to Aberdeen Standard. Aberdeen Standard were paying a near record price, and they decided to withdraw, but a French fund came in a matter of days and agreed a price within 3% of where Aberdeen Standard had been themselves. So I think that is a positive, and London generally retains a very strong profile in the market, and there is a lot of equity demand that is focused on that at the moment, principally overseas. And if you talk to agents in that world, they seem to be very hopeful that once travel restrictions ease sufficiently to enable certainly the overseas purchasers to travel and to inspect, to fulfill critical parts of their investment committee process, that we will see an increasing number of transactions. Allied to that, also, you've got some structural positives, and we might well have some questions and discussions around the future of the office. But from a vacancy and availability perspective, that's at record low levels, and therefore, well, if not record low levels, at extremely low levels. So Grade A space in central London is less than 3% of the available stock. But I think the main thing that we've all been focused on is the occupational story. And that has driven value changes primarily. So we talked about London offices. So they've been broadly flat and positively enhanced from December valuations, albeit not all of the benefit that we saw from the yield compression has come through in March for obvious reasons. But we also saw and have seen over the last 12 months positive movements around Southeast industrials, and also in supermarkets, and all of those are properties that have been relatively unaffected by COVID, albeit the health warning I would put around industrials generally, and not just the Southeast, but multi-let industrials, the rent collection figures were lower than anticipated or expected for the March quarter date in a number of instances. So probably nearer 70% versus the 90 to 100% that they would normally expect. And I don't think that's a surprise, as we see an increasing amount of unemployment coming through the system, and there are a number of very small businesses who will be materially affected by COVID and will have problems paying their rent. So the rent collection for June is going to be a lot tougher than it was for the March, because obviously for March you had January and February and most of March as sort of trading as normal, albeit in increasingly challenged circumstances. Regional offices also stand out as a property group that have been relatively resilient to date, and again the rent collection story has been pretty positive. Regional REIT, for example, who are a public company, had some very strong rent collection figures that they published recently along with their results. And a lot will go to the type of occupier that you've got in those buildings, clearly, who may be more resilient than others. On the negative side, no surprises, retail has, other than the supermarkets, has suffered badly, but that was already the case. And quite honestly, what has happened, I think, with the COVID situation is it has concertinaed the structural shift that was already occurring, and therefore it's just occurring at greater speed. We saw around a 10 to 15% reduction in Q1 in shopping centre valuations. I would expect there to be potentially the same again, if not more, depending on where and what it is. Particularly vulnerable will be those centres which have a high fashion content, for example, where online sales has really come on leaps and bounds during the lockdown process. And even where they're trading, I think everybody's hopeful from the 15th of June that will be the case. Certainly where they can abide by the safeguarding regulations, that there's still going to be a limited pool of footfall that people are going to be wishing to go out to purchase in covered centres. We're much more confident, I think, around or hopeful around out of towns units, where they're easy to operate from a social distancing perspective. It's easier to manage the flow. It's all car-borne traffic, and I think they will benefit earlier. And I think generally from a sustainability basis, you tend to have more affordable rents in that sector of the retail market, and you do have also underpinning for alternative use, be it or urban logistics or potentially residential in southeast locations.
So look, there's a lot to take in there, Charles. Thank you. I think you've just about spanned all the main sectors there, from industrial, from offices to residential, and indeed you talked a lot about retail. And I suspect we're going to go back to some of this again, because of course what we're talking about this morning are the different options that we are seeing being used by different occupiers, and thinking about how they embrace this whole financing thing. And of course, we'll come back to Roger, I'm sure, because we've seen quite a lot of raising going on in the equity markets, and thinking about Assura, thinking about Big Yellow, and thinking about what you were saying there about Supermarket REIT. We've seen, and Regional REIT too, we've seen quite a lot of equity raising going on. Now there's something about that, and in certain areas we've seen those being oversubscribed. So we know that the capital markets are functioning well, and we know that they're performing well. But let's go back to Peter. I'd like to introduce Peter into the conversation, if I may. Peter, what are your clients talking to you about when they're thinking about their finance options? I mean, obviously sale and leaseback, that's been in the news a lot. We've seen a lot of big corporates turning to sale and leaseback as their option. Is that the only game in town?
I feel slightly embarrassed going after Charles, because of course he's the main event, and I always that kind of estimation and summary engaging and helpful, and kind of, as lawyers, we tend to be the last in the queue, and we tend to respond to those valuation events and circumstances. But in response to your question, Kevin, traditionally we have seen sales and leasebacks, particularly into the long lease funds, in circumstances where we've had investment grade covenant supporting income. Capturing Charles's points in terms of sector, we have seen some changes in terms of the dynamic. The previously investment grade covenants ceasing to be investment grade. And in answer to your question, traditional exits, all involving some exposure to the marketer, of course, you can sell it, you can lease it, or you can raise debt finance on it alone, or in combination with joint venture partners. there are opportunities in terms of exit strategies to create derivatives or to convert to a REIT, but they're very specialist undertakings and they're not particularly available to corporate occupiers or others. So what we're seeing is entirely aligned to Charles's comments. We're seeing response around the government's position on moratoria on forfeiture. We're seeing risks presenting in relation to rent and its postponement, and we're seeing the long income market holding up, which is consistent with the news this morning in terms of position on material uncertainty and asset classes. And in our world, it's exactly a parallel of that.
Okay, thank you, Peter. Let's bring Adam in now. Adam, from a KPMG point of view, and indeed from a regional point of view, what's your experiences here? What can you share with the team?
Yeah, thanks, Kevin, and good morning again, everyone. I think clearly what I've seen in the Northwest, and this probably echoes across other UK regions, is, you know, rents are down across pretty much all sectors. It is an undoubtedly difficult time. Our expectation within KPMG is there will be a recovery, but it might be more like a Nike tick shape, a slow and steady recovery over a fairly long period. And that the way we will come out of this will be in a new reality. It will look different to what we've had before. And already I think the conversations I'm having with my clients are ones where we think things need to be reimagined and repurposed. And I'm thinking there about offices, for example, and how we use offices. There's a lot of conversation currently about what return to work or specifically return to the office looks like. My expectation, and I've spoken to a number of both occupiers and landlords in this respect, is we might see offices be repurposed so that you go to the office to meet clients and colleagues and to collaborate, but not necessarily to do your day-to-day tasks. That's been successfully proven in many industries to be successful from home. What we might see, I think, is the re-emergence of a more local hub office. So the net impact may still be slightly less office space needed by an occupier, but it might be spread across more locations, reducing commuter time and distance and all those environmental impacts that have been actually a little bit positive through these last 2 or 3 months. I think in retail, I think Charles alluded to this as well, we will see a massive acceleration of the trends we were seeing, but the high street isn't dead and won't be dead. There is a place and a purpose for our towns and suburban hubs that will have a much greater proportion of residential, more food and drink. We will get through this COVID period, and the long term will look positive again for food and drink and town centres. Retail can't survive purely online. Our UK head of retail at KPMG talks very strongly about those online only businesses that actually struggle for advertising when they don't have a high street presence. They need to fuel an advertising bill if they don't have a high street. So those businesses that think they can just remove their high street presence and be purely online, I think will find some difficulty doing that. So I think there's still a strong presence for high streets, but will change the way they work. And what I've seen in Manchester and the 9 or 10 boroughs around Greater Manchester is strong local public and private interaction and strong leadership that says this is how and why we're going to repurpose these towns. The Mayoral Development Corporation in Stockport being a good example of that. I cite that because that's where I live and what I see most of. But that's going to help to drive developers and investors to know what they want to invest in terms of buildings and developments, not just in Manchester, but UK wide. And finally, I think what I've seen is around funding. Funding has got more difficult since 2016. The hoops and hurdles that one has to jump through and over to access capital have got trickier, particularly from a debt perspective in the last few years, and that will continue to get trickier as we enter this period. But again, there's appetite, particularly internationally, for organisations who want to put money into the UK. There is investment out there, but it's trickier to get access to it. and companies and developers need to be a little bit shrewder about how they approach the market, how and when perhaps they approach the market to access that capital.
Okay. Okay, Adam, thank you. And that's a recurring theme we're going to come back to, is this whole position of public and private sector and how we might begin to see that change. Now, panel, thank you very much for your contributions. And I can see that we've already begun to see some questions beginning to arrive. And to our audience out there, please do keep those coming. Now, let's go back, if I may, to our audience and ask them a question. We heard Charles talk to us about some of the big challenges that have been happening to him and other valuation professionals. He talked about this was perhaps one of the most difficult periods that he's known in his 30 years of working in real estate. And I'd like to put a question, please, if I may, out to the audience. Let's have that question if we can. So my question for the audience to vote on is, do you think that the methodological, I can't even begin to pronounce that word, so I'm going to skip over it, so real estate valuation will be changing? And if you think the methods will be changing, please vote yes. And if you think that the methods will not be changing, please vote no. Now, panel, bear in mind what that question has to say. Roger, I'm going to come back to you, if I may, and talk about some of the impacts that you're sensing as happening from an investor's point of view when they're looking at asset valuation. And then, Charles, I'm going to bring the conversation back into you, if I may. And I'd like to talk to you, if I can, about this material uncertainty clause. So let's get the responses, if I may, back to that question that we've just put out. 71% think yes, there is going to be some material changes around the valuation principles. Great. Thank you, audience. Okay, let's get back to our conversation. Roger, how are you seeing this affecting real estate investment, and particularly from an exchange point of view? Where is this beginning to take the discussion? Clearly, valuation principles are phenomenally important to all investors, but are you sensing here that there are other areas of interest that investors have got?
Well, I certainly think that when you look at listed real estate companies today that already exist, that it's clear to me that investors are moving, investors in the shares of those companies are moving ahead to a place that is ahead of where we as a real estate industry are. What do I mean by that? You know, I often get told the old truism that listed real estate always trades at a discount, and it simply isn't true. When one looks at the current REIT market in the UK, almost half of them trade at a premium to NAV. And you, Kevin, you referenced some recent fundraisings earlier on. I think you referenced Assura, Supermarket REIT, and Big Yellow, all of which have raised money recently since we went into lockdown, all of which have done that at significant premiums to their reported NAV, and two of which actually upsized their fundraising quite materially to meet a significant investor demand. So why are people buying shares in real estate companies at more than they are apparently worth? Well, I think it's because what the market is doing is it's beginning to move to a place where it is looking forwards. This is what stock markets do, by the way. It's looking forwards and it's trying to understand what the cash flow generating propensity of those companies is. Actually, when you look at Assura's share price or Supermarket REIT's share price, people are looking at that and they're thinking the underlying tenants in those properties are good covenants that will pay their rent. They're going to pay rising rents, and this means rising cash flows, rising dividends. Actually, it's not a question of focusing on what the last transaction for a supermarket was at. It's a question of focusing on what the return from those shares will be. And if you like, this is pretty obvious because this is the way the North American REIT market has traded for well over 20 years now on something called FFO multiples, or multiples of cash flow. Part of the reason that happens in America is they have a less developed and a less expert valuation industry than we do. So the stock market has had to do its own valuations. I think we're heading in the same direction.
Okay, thanks, Roger. Really interesting, and we'll come back, I'm sure, to a couple of your points. Now, let's go back to Charles, if I may. So, Charles, the first question I've got for you is around material uncertainty, but there's also another point that's come in from our audience, and I'll take that one as well. So let's start with this material uncertainty clause. What would you say has been the impact of that clause, and do you think it has had an effect? Do you think it's slowed down the transactions in the market?
I think the first thing I'd say is from our discussions with investors generally, it's been welcomed that it's been put in place on a consistent basis by the valuation industry. I think consistency is the key point there. And the move to remove various asset classes, be it long-let annuity income or supermarkets let to major operators, for example, that consistent approach has also been welcomed. I don't think it has meant a lowering of volumes because those volumes were low in any event. You can see the facts there. It hasn't, to my knowledge, prevented any transactions taking place, albeit there will and are some banks who find it harder to fund situations where these clauses exist, and some investment committees won't approve a process until they're removed. However, what I would emphasize is it is not a question of the valuations not being able to be relied upon. What we are merely saying is statement of fact. We are in an unprecedented set of circumstances. Higher degree of caution should therefore be exercised when looking at the valuations, and they should be reviewed more frequently. And I think everybody, it's wise just to bear that in mind. And I think clearly the desire will be to remove this clause as soon as is practicable, and I suspect it will continue to be done more on a sector by sector basis. So, for example, you'd be more confident about an earlier release on things like, I don't know, central London offices, for example, relative to shopping centres or hotels. And I think that is, that's obviously driven by the circumstances that we find ourselves in.
Okay, great, thank you. Right, let's just pause a minute, and I'm going to just come back to Roger again, if I can. Charles referenced there the importance of frequency of valuation. Roger, could you just tell us a little bit about how valuations work for those issuers and their assets on IPSX?
Yeah, so at IPO, I mentioned the prospectus earlier on. At IPO, that prospectus will include a RICS-compliant, Red Book compliant valuation. Because we're a property stock exchange, we actually think it's appropriate to ask the valuers to actually be members of our exchange. And indeed, there is a valuers working group that we've set up that we really want the valuation industry to get behind this and agree how we want to be prescriptive, if at all, around the contents of evaluation. And it comes back to the point I made a moment ago. What we're trying to do is go beyond what you sometimes see appear at the portfolio level in a prospectus or an annual report at the moment, and actually give the readers the chance to understand on a forward-looking basis how that covenant and that asset, ERVs at it, are going to behave in the future. In terms of frequency, once the IPO has happened, the issuer needs to refresh that valuation at least once every 6 months.
Great, thank you for that. Okay, so Peter, I'm afraid you're still in the spotlight here, and then, sorry, Charles, you're still in the spotlight. I'm going to come back to you on the question, and then Peter, there's a question for you that I'm going to come back to, and then Adam, I've got one for you coming up as well. So let's go back to Charles again. There's a question here that's asking you about how a public market, let's just read the question, it's a lot easier for me. Would a dedicated real estate public market inform the valuation process in the context that currently valuers are starved on comparable evidence? And you please answer that question in any way you would like.
Okay. Well, I think the first thing to say is any additional data and information and insight is useful. I mean, I think let's be absolutely clear about that. The thing I would emphasize, and I think you'll already know, is valuations are often criticized for lagging. One of the reasons for that is they are a snapshot of value at the time of valuation. So they assume, the valuation assumes that the property has been marketed and is selling on the day of valuation. So whilst inevitably or much desired to ensure that you're looking ahead and anticipating and reflecting what a bidder would be forming a view on the day of valuation, it isn't in the same way as pricing a share, which tends to be A, more liquid, and B, tend to reprice much more quickly, looking at ahead down the line of things that may happen. So I think there's always going to be potentially a conflict between what people see as a valuation of an asset and a valuation of an equity, for example, or share, where that may have a more of a forward look and anticipatory look. But it may well be that one of the things that come out of this is that the valuers will need to be more cash flow explicit in their appraisals, and not use, and they are pretty explicit at the moment, but more sophisticated. And I think that will come down to the type of assets that they're appraising.
Yeah, and I think that's probably reflected back in the response that we had from our audience when we were asking that question about, do we think that valuation principles might be changing? And I think this is pointing towards that. So really interesting comment. Thank you. Thank you. Very, very good. Let's keep the conversation moving ahead, if I may. Peter, I'm going to come to you now. We've got a question here about JV structures. And we know in real estate that there's an awful lot of real estate assets owned through club deals, JVs of all sorts of descriptions. The question really is, obviously JVs have been a good source of fee income for lawyers in terms of the time that it takes to construct those and to put those agreements together. But in your view, would IPSX Wholesale perhaps offer a more straightforward approach? And Roger, perhaps you might like to come in on Peter's reflections.
Certainly, in my experience, JV structures are ordinarily designed with a shorter term life cycle with a view to value add and income capture, with the anticipation sometime, somehow, that asset or the JV structure will exit. And my anticipation is that those traditional JV structures calculated to create value, not with the intention of long-term stewardship or hold, will continue in much the same way as they have continued or they've been rolled out historically. What's always a conundrum in the context of a JV structure is your route to market. Now you exit with a clean edge, and the anticipation ordinarily in traditional markets is that you sell to somebody that is interested in holding that asset long term. Where possibly the exchange may be helpful is in terms of offering exit strategy and giving another option to JV structures once that value has been created. I don't know if that makes sense, Roger.
Yeah, no, let's go to Roger. This has been a topic I know of much conversation and debate. So could you share your views on this?
Well, Peter's spot on in every way. That's the answer I would have given. I suppose the one thing to add is the rather nice thing about a listed exit. You know, if the JV has been set up on IPSX, and remember we talked earlier on about how the new wholesale market can have JVs like that on the market. They can be REITs, they can be listed throughout the life of the JV. But importantly, what it means is that the exit, should there be a desire for different parties to exit at different times, is much easier to execute. We all know that there are provisions always in JV agreements that cover the eventuality where things don't go as planned, and exit provisions have arbitration clauses, they have independent valuer clauses, there's got to be some treaty and agreement, all of which is super easy if you just have reference to a share price. And of course you can sell into a stock market listing much more easily, simply because the addressable audience, going back to the points again we were talking about earlier on, is just so much bigger.
Okay, great. Let's just change tack a bit. We've been talking a lot here about private sector, companies, owners, occupiers. We've been thinking about how these different options now are beginning to surface, and we've been talking a lot about values and how we realize values about real estate assets. Let's just turn the conversation, if I may, slightly away from the private sector and into the public sector. And there's been a lot of commentary about what's been going on with the reviews of the Public Works Loan Board. And we've got a question here about how this might affect in the future what we're going to see happening as a result of that review. So the question is, local authorities' financing has been in the news, especially buying some 6.6 billion worth of assets over the last 3 years. Let's ask that question. Do we think that this review is going to cause a problem particularly for local authorities in the Northwest? Let's go to Adam first, if I may, and then perhaps Charles, Peter, Roger, you might have a view on this too.
Yeah, thanks, Kevin. And it's an interesting question. It's one that has come up a few times in other panels and forums I've been in. My view at the moment, as things are, is no. I think we have a open market approach to asset ownership, and I think that's healthy. I think a mixture of public and private investment and ownership gives variety and diversity, which I think is healthy. I think perhaps what's behind the question might be the access to capital that might be different between public sector investors and private sector investors, and it might not be perhaps the perfect level playing field that we might be wishing for. Perhaps that's behind the question. My view is it's right that we have that, and actually as we come out of that, I describe that Nike tick recovery. As we come through that process over the next few years, public sector investments and sort of drive for changing and improving our real estate and our towns and cities is going to be really important. I think it would have to go quite a lot further down the track of public sector owning assets to be too far down that track to need any kind of intervention or change to that. Okay,
Peter, what do you think?
I echo Adam's point, and as a business, we've been up close and personal with these transactions. And what I would say from an entirely personal perspective, I think it's indicative of the activity in the Northwest of a strong civic leadership in the Northwest. I think it's often a product of local authorities intervening in circumstances where the market hasn't intervened, where they need to create assets of community values, which not necessarily in pursuit of entirely speculative investment. There's definitely an element of public stewardship and propriety around that investment, calculated to regenerate shopping centres that might not otherwise have a value or currency in the current market. And also from a very legalistic perspective, Adam's point well made in terms of access to capital, but the relative situation, that access to capital is really carefully controlled in terms of public powers, and it's properly scrutinised in terms of what local authorities can and can't do. So there's no abuse of privilege. And I think what tends to get slightly florid in the overreaction is this assumption that it's kind of local authorities playing at property investment. It's far more complicated than and absolutely from our perspective as a purpose, and is very regulated.
Yeah, great. Let's go back to Roger, if I can. Roger, clearly there's a need here at a local level, at a regional level, to be able to raise finance, to invest in new development, and to be able to create jobs, and to be able to intervene into regions and areas which need that kind of investment. From a wholesale perspective, what is the ability for a local authority to be able to use wholesale? Can it, or is it only for private sector?
Yeah, no, that absolutely can. And I think that, picking up on the themes that the panelists have just been saying, I think that where local authorities are looking to regenerate their areas and provide more housing, improve placemaking, someone had to use that word, that's exactly what they should be doing. And of course, traditionally, what we've seen through these tortuous OJU processes, which certainly we've seen lots and lots of, is that local authorities tend to be, they have a lot of assets, they have a lot of land that they can put into partnerships, and what they need is some cash, but often they actually need private sector expertise to help them bring schemes forwards. And it's just got really clunky and really difficult. Lots of people are being put off. Even people the size of Argent are being put off now by the bid costs involved in going through these processes. I think it all just gets a lot easier if that partnership can come through a stock market listing, not least because one of the big issues in Green Book processes is this value for money requirement, which certainly a lot of the advisors we're speaking to say the stock market, the IPSX solution is great because it solves one of the most difficult things to advise on, i.e. is this proposition, is this partnership best value for money? It definitionally is if it's been marketed universally. So we're going to see a lot of public sector use of IPSX wholesale.
Okay, and sorry to cut across you, but what about development projects? So projects that haven't been started yet, could wholesale be used to be thought about raising finance for new projects?
It's most definitely, yeah, and especially if it's a public sector partnership, because one of the concerns that you have in underwriting a development project, speculative, is who's going to use it, will they pay for it? Again,
okay, very good. Thanks for just clarifying that detail. Ad, I'm going to come back to you and then to Charles, if I may. We've got another question here for you, and this is now swinging us back again into the corporate environment, into the corporate world. So we're going to start with Adam, and then I'll move to Charles, and perhaps Peter, you might like to comment on this as well. This is about what sort of level of activity are we seeing around corporates considering their portfolios and considering their options. So the question, Adam, I'll start with you, and then perhaps Charles, come to you with your reflections about how many inquiries that you're managing at the moment from the corporates thinking about asset values, and then Peter, perhaps you might like to come in on that too. So the question, Adam, is, are you seeing an increase in level of corporate occupiers thinking about monetizing their assets?
The short answer is yes. It's a binary question, so my answer is yes, we are. I think the perhaps longer answer is it depends on the organisation. The current time, you want to preserve cash and manage cash. That is the primary objective of most businesses right now, is about looking after people, preserving cash, and making sure that their longevity is protected. And in some cases, that will require monetizing of assets. In other cases, there's an element of what's our core business proposition here? Let's get back to what we're good at or what's going to work well for us, and let's not get distracted by some peripheral projects or investments that we might have had exposure to. And in those cases, I think there's a really strong argument to talk about monetizing the assets.
Yeah, and let's go to Charles then. Now, from your experience, Charles, are you seeing a growth and an increase in level of requests to work directly with corporates on valuing their real estate assets?
We are seeing a bit. I wouldn't say we're being it's a tidal wave. I think what we are seeing is that, you've seen in the market, people like Next come to the market with a sale and leaseback, both of their distribution centre and also their head office outside Leicester. And that's attracted good pricing and good interest, so good covenant, well-respected business. But then you've got the likes of Matalan, for example, who also have an office in the market where they cease to pay their rent almost instantaneously on their retail shops, and it gave people less confidence about pursuing them as a tenant, I think. I think one point I would make is, I think finance directors are very conscious about not tying themselves into long-term liabilities on assets that may not be key part of their business going forward. So they'll be paying very close attention to that, as opposed to just wanting to get the cash through the door.
Okay, and from your experience, Peter, looking across your client base at the moment, would you say that you've seen an increase over the last sort of 4, 6, 8 weeks of interest in this?
I've not seen an increase in activity, trust me, over the last 4 to 6. What we're seeing from the institutional clients is an estimation around sort of working practices. Now, those might change. And I think that the received view is that the current circumstances will be impactful, but not manifestly so in the long term. Charles, you talked about evolution. We've seen acceleration in terms of people's perceptions of space, particularly institutions, and their take on office markets. Very much of the view that there's an element of response now that will even itself out over time, and the office isn't dead. That's definitely the perception in the market. We have seen over the years an increasing tendency for corporate occupiers to exit via sale and leaseback, or obviously in certain markets, particularly for the banks, the financial institutions, the building societies, has been a surfeit of space in relation to surplus portfolio as the banks move online, and that's just been continuing, and possibly that's going to continue in the normal way, in the normal kind of anticipation that we all currently have. But we're very much seeing this is a moment in time, and our clients are anticipating resumption of normal activity as soon as time and circumstances permit.
Okay, thank you very much. Well, look, let's now, when I'm moving into the closing minutes of the session, and what I'd like to do is put the panel on standby. I'm going to come to the panel shortly for some your closing thoughts and some closing remarks. But before I do so, let's go to the audience for our last question of the morning. And panel, I'd like you to then perhaps reflect on the commentary that we get back from this in your closing remarks, if I may. So let's have a look at this last question for our audience this morning. Do you think that the Northwest market is in a good place to recover more quickly than other parts of the UK? And if you think the answer to that is yes, then of course please vote yes. And if you don't think that is right, please vote no. So audience, please vote away. Tell us what you think. Okay, let's take the question away, and hopefully we've got a fairly emphatic result, I'm sure. Let's go and have a look at that. Ooh, interesting. Okay, not as quite as emphatic as I was expecting. Right. Okay, thank you very much, audience. Very interesting. So we're going to close the session up now. So I'm going to finish first of all by asking Adam to give me his thoughts. Charles, going to come to you. Then penultimately to Peter, and the last word will be with Roger. So, Adam, your closing thoughts, reflections back on the session, and particularly your views on what we just saw there from the audience.
Well, my vote to that question would have been yes. I think the Northwest is in a good place, particularly the two bigger cities in the Northwest, in Manchester and Liverpool. I think the key to that reason really is the underlying demand that I think is there, regardless of perhaps some of the economic turmoil we may well see. There is a need for housing. There is a need for offices and high streets and people to collaborate together. Human beings need to collaborate at the end of the day, and that requires place and therefore purpose for it to happen. So that's my overriding sentiment. I think I would also add that Charles opened earlier with comments about rent and the fall in rents that we saw in March, that we almost certainly will see to a greater extent in June, sadly, and possibly even as we go through the next few quarters into September and December. This may well still be a tricky time, will be, I think. My view here is the government has done a lot to help businesses and to help ease the burden that they felt in terms of cash drain and inability to transact and work in the last few months. But that needs to not be at the expense of the real estate world and the landlord. And there are businesses who need rent deferrals and rent holidays, but there are businesses who don't need that. And my enthusiasm is to make sure that the two marry up well through sensible conversations. And part of KPMG's role in both real estate world and occupier world is to help bring the two together to give sensible conclusions to what rent levels should be and how rents might be structured in future. It will look different, but we have to be sensible and collaborative.
Well said, Adam. Thank you very much. Charles, what do you have to say? What are your closing remarks, and what would you like to leave with the audience today?
Okay, I've got three thoughts, maybe just two observations to leave us all with. Great. I think the first one is to expect more value markdowns following the June valuation round, pretty much across all the sectors. Key around that will be the rent collection stats and how the tenants perform. The second point is I would concur around this being a point-in-time event, but if you look at the horizon of how long does this point in time last, coming out of lockdown and through recovery, and the longer it goes on, I think the slower the recovery will be, albeit sustained. And different asset sectors, property asset sectors, are going to perform at different speeds. Mm-hmm. And that leaves me with the third point, which is within those asset classes, I think pricing will continue to follow a flight to quality, and specifically a focus on the type of corporate tenant that is being priced in terms of the rent flow. So might be a very good company, but if you're operating in aviation versus, say, pharmacy, then from a client's or a purchaser's perspective of minimizing risk, that's clearly going to be uppermost in their mind.
Okay, brilliant. Thanks very much indeed, Charles, for your closing remarks. Peter, as our virtual host today, and again, thank you to the team for everything that you've done to put this together. What are your thoughts, and how would you like to close this session?
Thanks, Kevin. I mean, thank you for allowing us to partner with you today. And from my perspective, it's been a very interesting dialogue. We always keep points under advisement, don't we, as practitioners and in our sector, in terms of exit strategies, liquidity, sector focus, and just reflecting on Charles's point in terms of points in time. It feels to me, very much listening to debate today, all of that has catapulted us to confront those issues in such a way that in my 30 years, I've never had to do that before. And it's interesting to talk about the exchange, to talk about options, and to see the next stage in all of this, and who knows what that will be. And to think, you know, so many schools of thought, observers and commentators will say that it's knee-jerk, others will say there's going to be sustained impact. Just have to wait and see.
Great way of finishing. Thank you. Okay, and Roger, you have the floor to close. Thank you.
Well, again, Kevin, I'd echo your thanks for Peter and his colleagues. Is the Northwest a better place? I don't know. I'm not going to comment on Northwest versus other regions, but I do think that one of the things that will be an effect of lockdown and COVID is that this country will become less London-centric. People will want to commute less into London. People will want to I think people will still want to have offices, but they'll want them in other places, as Adam was saying. So yeah, look, closing thoughts. We've definitely seen and are continuing to see a lot of change. I think everyone agrees on that, and the crisis is accelerating a lot of changing trends which were underway already. Personally, when it comes to are these going to be long-term fundamental changes, I think that remains to be seen. I don't think it's disagreeing with anybody to see these ideas that the death of the office and we're all going to work from home forever. I'm not sure I agree with that. But what is clear is that people are open to thinking about new things. As Peter says, new options, some flexibility of thinking and new ideas and new approaches. And in an industry which is often quite conservative and sees a lot of inertia, that's a really good thing.
Great, thank you, Roger. And let me just by closing by saying on behalf of the audience, thank you to Adam, to Charles, to Peter and to Roger to giving up your time today and taking us through what is a fascinating topic and continues to be probably the one that is going to be at the heart of many, many conversations to come. As corporates, public sector, investors, we all look at what are the options that are best for us when we are thinking about the flexibility we need, the cost base that we're running to, and the finance options that we have to run our businesses. So it's been a pleasure to run the session for you today. Thank you very much indeed for joining us. If you'd like to learn more about IPSX, please do jump onto our website. There are plenty of podcasts there and indeed other webinars on other topics that you might like to take a look at and indeed to download. But first of all, thank you very much indeed. And finally, thank you all very much for joining us, and hope to catch up with you again very soon indeed. Thank you and goodbye.